Welcome to Questions from the Web with Graham Home and Dr. Andrew Wilson. This week's question is from Sean.
Sean says, he's directing this at me a bit, but I hear Graham talk about risk mitigation a lot. Should I be, I'm looking at my first investment, should I be investing in the same suburb my home is in, or should I be looking to diversify and risk mitigate? So let's just assume, I don't know where it is, but let's just say Sean lives in Western Sydney. Should he be buying in the same suburb because he's an expert of that suburb in Western Sydney, Doc? Or do you think he should consider a couple of suburbs away, a different state? What's your expertise or thoughts on this?
Well, I think if you're an investor and they should be looking at the longer term, you want to look at wherever you're getting the best return, right? Now, if you're in a higher price suburb.
Hang on. Sorry, Doc. So you said you should be looking at where you think you can get the best return, not where you think you know the most about something or what's local or familiar to you.
Yeah.
Straight away you said the best return.
Yeah, that means yield. And, yield is important because yield is the return you get as a proportion that's from your rent, as a proportion from the value of the property. So the higher the yield, the better. It means that you're getting more of a return, more bang for your buck. And it's not necessarily you're going to get a higher yield in wherever you're living because you're living in that area for reasons other than investment return.
Yeah,
right?
Your family's there and sport and work. It's
right.
And it's an owner-occupied. You've got a mortgage there. It's maybe more of an owner-occupied leafy suburb.
And because of that, it'll likely have a lower yield because your property value is higher. But you want to be looking for somewhere, or a unit versus a house because you get a higher yield typically with a unit. That you're going to get a better yield. It doesn't merely just go for whichever suburb has the highest yield.
No,
you also
never.
need to have other factors, such as, well, is there a low vacancy rate? Well, just about everywhere in Australia, the answer to that is yes. Is the economy doing all right there? Well, if you're in a capital city, the answer to that again is yes. Is there more development coming into that area? So there's going to be more supply. Well, the answer to that probably again is no. So it is all about, sort of doing your homework, but people can be more comfortable in one area compared to another if everything else is sort of basically the same. So if you've got a high yielder in Sydney versus a high yielder in Melbourne, maybe you prefer to have your property in Sydney rather than Melbourne, or maybe vice versa. Maybe you're looking to say, well, I want to take advantage of a market that's going to have perhaps a slightly different cycle to Sydney in terms of capital growth. But I do think that you've just got to do your data homework and look for the key. If you're an investor, obviously it's your rate of return. That's what it's all about, isn't it? And to consolidate that is through rentals because that's what's coming in every week, and you get the ebbs and flows of capital growth. We all know that over time, capital growth is very positive in Australia as well. So, but at the end of the day, it is about those the yields and getting the most bang for your buck. So, and that can be anywhere. And then when yields are sort of all equalised, all those factors, then you can think, okay, well, I like this apartment better than that apartment, or I like this house better than that house.
Yep.
I like that suburb better than that suburb. I like that capital city better than that capital city. So that's about personal choice, Graham.
So that's a good one, Doc. There was no emotion there. It was start with yield, start with return on investment. Is it costing you? Is it making you money? It's expenses.
Yeah.
And if it's got a strong or good yield, and then it's ticking the boxes of vacancy rates, supply, demand. Once you've gone, then you maybe look at capital growth and go, well, how's it performed historically and what's it likely to perform? But I love you started with yield. That's my preference as an investor because long term, everywhere's had capital growth. But not everywhere has a good yield. Some properties cost you the entire time you hold them. Some of them make you money along the way.
Yeah, and the point is if you're getting your income coming in week after week, capital growth is icing on the cake, isn't it? Because what you're trying to do is create an income stream, take advantage of all those tax, or take advantage of those tax, packages that you have as an investor, capital gains, discounts, negative gearing, tax depreciation, all those sort of things. And, we have 3 or 4 million small-scale investors in this country, Graham, and they're not all dills, mate. They know what they're doing, and that's why there's so many of them.
That's right. It's almost a profession or a job for a lot of people now. If
Absolutely. It's a business.
If they're getting the right yield, it's a business. So So, Sean, I hope that answers your question. It got me excited to end the session this week. It's actually got me a bit excited. Doc's talked about yield first there because if you invest to make money, ladies and gentlemen. And if you make money along the way, the capital growth is, as Doc said, the icing on the cake.